Welcome to This Explainer. Today, we are going to unpack a truly fascinating situation playing out right now in the heart of New York City. We're looking at SL Green Realty Corp's first quarter of 2026, and honestly, it's a classic tale of two completely different ledgers. On one hand, we have this record-breaking physical real estate demand, but on the other, a balance sheet that is battling massive macro headwinds. So, let's dive right into this paradox.
To hook you right away, $4.7 billion. That's a B. It's the staggering, recently established valuation of SL Green's absolute crown jewel, One Vanderbilt, which stands tall right in Midtown Manhattan. They recently sold an 11% stake to Japan's Mori Building Company, and that transaction cemented this massive $4.7 billion price tag for the 1,401-foot trophy tower.
And, there's a very good reason for that jaw-dropping valuation. CEO Mark Holliday really hit the nail on the head here. He points out that well-located, highly amenitized, and sustainable buildings are basically just absolute magnets for premier tenants. And he's definitely not exaggerating. The top floors of One Vanderbilt have actually commanded asking rents of up to $322 per square foot. It just proves that in the modern office market, top-tier quality still commands a massive, massive premium.
But here's the thing. It's not just about one iconic building. In the first quarter of 2026, SL Green signed 51 office leases totaling nearly 1 million square feet, 929,264 square feet to be totally exact. To put that into perspective, that is the highest first quarter leasing volume they have achieved in their entire 28-year history as a company. Just think about that for a second. In an era where we are constantly hearing about the death of the office, Manhattan's largest office landlord literally just had their busiest first quarter ever.
What's truly fascinating, though, is the actual rent they are getting on these new leases. For replacement leases, so spaces that have been occupied within the last year, the new starting rents are actually 16.1% higher than the previous fully escalated rents on those exact same spaces. The average starting rent for the quarter hit a record $105.12 per square foot, so they aren't just desperately filling empty space, they are actively increasing the rent roll.
The Q1 earnings release really shows how this massive leasing volume translates to the bigger picture. Manhattan's same-store office occupancy climbed to 94.4% by the end of March 2026, and management isn't stopping there either. They're actively targeting a 95% occupancy rate by the end of the year. So purely operationally speaking, the buildings are humming.
Okay, but here is the plot twist. You might be wondering, how does a company with record leasing and rising occupancy end up here? Despite all these record-breaking operational wins on the ground, SL Green's net losses actually widened dramatically. Back in Q1 2025, they had a net loss of 30 cents per share. Fast forward to Q1 2026, and that loss quadrupled to $1.20 per share.
The underlying financial strain becomes pretty obvious when scanning through the operational expenses. There is a massive, glaring jump in interest expenses, which we are going to dig into in just a moment. But basically, it shows that even when the physical properties are generating fantastic revenue, the cost of just running the business behind the scenes is absolutely escalating.
Before we dive into the specific numbers explaining that loss, let's bust some quick real estate jargon, FFO, or funds from operations. This is a super crucial metric, because real estate assets technically depreciate on paper, but often appreciate in reality. Standard net income isn't always the best measure of a company's health. So FFO adds back that depreciation to give us the truest, most accurate indicator of a REIT's actual operating cash performance. So, keeping that FFO definition in mind, the Q1 2026 financial highlights tell a really stark story. Overall revenue was a very healthy $253 million. Property-level income, which is their same-store net operating income, actually increased by 2.6%, but the FFO per share, it plummeted from $1.40 a year ago down to just 84 cents today. So cash generation from operations took a massive hit, even though the properties themselves are technically bringing in more money.
Why? Well, it all comes down to the interest rate trap. The current macroeconomic environment of higher-for-longer U.S. Treasury yields is just drastically increasing the cost of financing. SL Green operates a multi-billion-dollar real estate portfolio, right? And commercial real estate runs on debt. When those interest rates spike, the cost to carry or refinance that debt skyrockets, effectively crushing the bottom line, even when the buildings themselves are practically full.
The sheer volume of this debt is intense. We are talking about over $4.4 billion in total debt, net of deferred financing costs, and that spans across mortgages, revolving credit, and unsecured term loans. When you have this much leverage on the books, refinancing isn't just routine paperwork anymore. It turns into a high-stakes challenge dictated entirely by whatever the current interest rates happen to be.
Section 1. SL Green's Survival Playbook. Defending the Balance Sheet.
Now, SL Green isn't just sitting by letting rates dictate their fate, they are actively fighting back. They are executing a rapid-fire survival playbook. First, they tackled refinancing head-on, securing a massive $1.65 billion fixed-rate refi for 1 Madison Avenue at 5.81%. They also successfully extended and slightly reduced the cost of $2 billion of their corporate credit facility. And to secure necessary liquidity, they're trimming the fat. They're selling the residential and retail components of 7 Daisy Street for over $222 million and 690 Madison Avenue for $54.5 million. It is all about raising cash and locking in known debt rates right now.
Section 2. Bull versus Bear Outlook. Competing Visions for Manhattan Real Estate.
This whole situation sets up a really fascinating clash in the market. It really comes down to which side of the ledger you believe will ultimately win out. The bulls argue that this flight to quality is absolutely real. These premium, fully amenitized buildings like One Vanderbilt will just keep attracting elite tenants, and as those rents rise, cash generation will stabilize and eventually outgrow the debt. The bears, however, are waving red flags. They warn that the crushing weight of higher-for-longer interest rates and relentless refinancing risks will simply overwhelm any of those operational rental gains we talked about earlier.
Which leaves us with one final provocative question. Can rising occupancy truly outrun rising debt? SL Green is doing everything right on the ground, filling buildings, signing leases, and raising rents at a record pace. But until those macroeconomic winds finally shift, their balance sheet is going to remain a battlefield. It is going to be incredibly fascinating to watch this play out as the post-pandemic Manhattan skyline continues to evolve. Thank you so much for joining me on this explainer. Keep learning, and I'll catch you next time.